What's up, everybody? So in this section, we're going to talk about fake outs. Now, how do you define a fake out? A fake out is when price is consolidating, and then instead of breaking to the top side, it does break up, or let's say if it's breaking to the downside and it does break down, it just goes to the opposite way from the bottom up, or it goes to the opposite way from top to the downside, right? That's basically a fake out. Now, when do fake outs happen? Why do they happen? Can you really spot them? Can you anticipate a fake out? The first things first, you cannot anticipate a fake out. It's really, really difficult to anticipate a fake out. That's like the same thing saying that, let's say you're playing soccer and you're like, okay, will this guy dodge me or will this guy fake me out? There's no way it's going to happen. You're never going to be able to fake that, anticipate that. Now, when do they happen? Fake outs normally happen after price is consolidating, right? So let's say you have a session, let's say you have a pre-London session and you notice that price has been ranging during pre-New York, or let's say like, London Open and pre-New York, and now you're saying that, okay, like, you know what, we've been ranging since London Open and pre-New York, maybe we're gonna have volume at NY Open. And at NY Open, let's say at consolidation, price breaks down and then price just goes the opposite way, right? That breakdown, that was the fake out, because price tried to move to the downside, but there was something there that made price come back in the range, and then price went the opposite way. That's a fake out. Fake outs happen all the time, right? So we need to understand this one more thing. Price will always move either up or it's going to move down. We as traders, we need to identify that what's the probability of price moving to the top side or price moving to the downside. Sometimes while price is consolidating, it's going to continue pushing bullish. And sometimes our price is ranging, it may continue to move bearish. So what we're going to do here now, we're going to pick up a few, they're basically just two variations of fake outs, right? There's a bullish fake out and there's a bearish fake out. So we're going to talk about those right now. All right. So first of all, we're going to talk about the bullish fake out, where price breaks to the top side, comes back in the range, and then starts going to the bottom side, right? So we have a resistance and we have some sort of a support down here. Right now, for example, we have a candle that's basically bullish at this point. We're bullish at this point and you're like, okay, you know what? It's perfect. The next candle goes bullish, we break out of the range. Now we've broken out of the range. Now once we've broken out of the range, we're thinking that, okay, now let's say price has been consolidating for a little while over here. Once we've broken out of the range, we're thinking that, okay, now there's a higher probability for price to continue pushing up. Now either you're looking at an impulse entry or you're looking for a retest. So let's say, for example, for simplicity, we're looking for price to retest this broken resistance. So what's going to happen is that we may see another bullish candle go up, and after this we see a bearish candle start to push down in such a manner. Now when we see a bearish candle start to push down, we're like, okay, perfect, we've broken outside of the range. Now there's a high probability for us to create some sort of a support, and then you see another bearish candle that forms at this resistance. Now after this, you see that, okay, we have a bullish candle forming at this point. Now the fake out is going to happen when there's going to be volume in the market, right? So let's say, for example, this is pre-London, or this is, London Open, or pre-New York, New York Open, NYC, whatever type of volume there is, we've studied that. You're anticipating the next candle to either break this high, or you're trying to take a buy at this point for price to go up, right? So let's say you're actually taking a trade. Now, instead of moving up, what we see is that a candle forms and it closes back inside the range. Now when you have a candle closing back inside of the range, now this is going to be more prominent on a 30-minute time frame, not on the 15-minute time frame. 15-minute confirmations are weak confirmations. So I like to look at this on the 30-minute time frame, 1-hour time frame, 4-hour time frame. This also happens on the daily, weekly, stuff like that too. So let's say this is happening on the 30-minute time frame, right? You have a candle closing back in the range. Now this support, right, ideally becomes your resistance at this point. Now there are two variations this can happen at this point. Now if you're anticipating volume, there's a very, very high probability that the next candle can retest this area and then start to push down within this range. Now if you're going to trade this range, you need this range to be at least, I would say, 30 pips. This range has to be at least 30 pips for you to take this fake out trade. Now, this whole move to the top side, this is what we call a fake out, right? The reason why is that price tried to move up, right? Price broke out of consolidation. It tried to move bullish, but it closed back in the range. So when you have a prominent time frame, like a 30-minute time frame closing back in the range, after breaking out, there's a very high probability that it's going to continue pushing back down to the bottom of the range. And if there's more volume, we could also see price further dropping outside of this range and actually continuing to push down if there's more volume, right? So these things will happen. Now, the main thing to understand here is that price actually tried to break out of the range, right? This is very, very, very important. So whenever you're trading, you have to constantly talk to yourself. If you took a buy right here, right? Let's say that you took a buy right after you had a candle closing bullish, you took a buy, and like instead of price moving up, price went back in the range and closed bearish. Now your buy is nullified. Right? You're getting out of that buy. You're no longer holding that buy because now you understand that, hey, maybe this move up was a fake out, right? Because now we have a candle closing back in the range, so I should better get out of that buy. And as you move along the market fluidity concepts, you start to become fluid enough to understand that, okay, maybe we're not continuing to move up, so maybe the dynamics of the direction of the market has changed. Right? It's very important for you to read the candles, right? So when price comes back in the range, this is where you're saying, okay, like, you know what? We've closed back in the range. If the next candle breaks this low, this is more discussed in the impulse entries. If the next candle breaks below this low and we have a 30 pip range, I think there's a very high probability for price to continue pushing down in the range, right? So remember I talked about there's going to be two variations. This was the first variation. Now we're going to talk about the second one. It's very important we 100% totally understand how price is moving, how price is acting for us to really take advantage of these fake outs. Now, for example, instead of price closing like this, we have a bigger candle that closes in the range. Right? Now what's going to happen? Once we have a bigger candle closing back in the range, if you're looking for an impulse entry right here, what we talked about in ranges, in way to take a trade, whether at support or resistance, we understood that if you're trying to take a trade right here, as the next candle wicks up and starts to break the previous candle's low, is this a good entry right here? Is this a good entry in the middle of a range? Absolutely not. This is the worst possible entry you can take because essentially you're taking a sell while price is in the middle of a range. So even though if this is a 30 pip range, your tradable range is maybe like 10, 15 pips. What are you going to do with this, right? You can't do anything with this, right? Because your range is essentially smaller now. 30, let's say like 15, 10 pips, like if you factor in the spread as well, right? So it's not enough. So at this point, what's going to be much better for you to look for is for a possible retest and then a continuation down. Because if this is a 30-minute time frame, we already tried breaking up, right? Did that work? No, it didn't work, right? So there's an 80% probability now we will continue pushing down to the bottom of the range. Now, also remember, there's a low probability that price may continue pushing up. Right? We have to keep that in mind. It's not all the time the price will continue pushing down because we always talk about in probabilities. There's a very high probability we may continue pushing down. Like a lot of traders have traded these fake outs. They've been successful at it. But also there's a small possibility you have to understand that price may start to continue pushing up. Right? And also remember, one very important step. If you're trying to trade this fake out, right, and only trade and execute on the fake out if you did not execute on the buys. Now, how would you know this is a fake out? You wouldn't know. The only way you're going to trade on the fake out is that if you have missed your execution on the buy. right? For new traders, if you execute it on the buy and price comes down and you know that this is a fake out and you studied in Smart Roger Concepts that this may be a fake out, don't execute on it. Just watch it play out, right? You watching how price moves, that's going to be your biggest development as a trader, 100%. Right? So always understand there has to be range for you to take a trade, right? And this candle closing down here, you have to wait for a retest. If the candle, let's say the candle closes back in the range like this now gives you enough range to take a trade, right? It gives you enough range to take a trade. And if this is a 30-minute time frame, there's a very high probability it's going to work out. Right? So this is very important. Look at these examples in the charts. In the past, you will see that there's a very high probability price has moved in the opposite direction. Now, a lot of you people may know some stuff, but going over these basics, it's going to rekindle something. It's going to light up that spark or light up that bulb in your mind, and you're going to say, oh, you know what? This is something I missed, or this is something I didn't factor in while trying to trade fake outs. Now, we're going to talk about the bearish fake out in this scenario. Now, it's also true for the opposite. Let's say we have a resistance up over here and we have a support down at this point. Now, let's say, for example, we have, bearish candles that start to break down all the way from the top hand side. We're starting to break down on the bearish candles. Now, if we're starting to break down the support and you see, okay, there's a probability for price to go down. And now what we see in this bearish fake out is that we have a retest and candles start to print down. Instead of continuing to the bearish side, we see sometimes, a candle that forms like this, a rejection at this point. So whenever we see a rejection below a support, or let's say price started to move down and now we see some sort of rejection, there's a probability that price may do a retest at this point and then continue on pushing down. But instead, what happens is that you have a candle that instead of going down, we close back up in the range. Now, this is the opposite of what happened in the bullish fake out, right? In this bearish fake out, there was so much volume that price broke below support, right? We closed below support and we had confirmations that now we may have a retest to continue down, but instead of a retest, price closes back in the range, right? So whenever we're closing back in the range and we do understand that this may be a 30 pip range or even like a 40 pip range based on a 15-minute time frame or 30-minute time, especially on a 30-minute time frame to a 1 hour time frame, if this is a 30 to 40 pip range, this is a perfect opportunity for price to continue pushing to the opposite direction. Because again, price tried to break down, it couldn't maintain its bearish move, so it closed back in the range. Now visually, what we're anticipating is for the next candle to wick down and continue pushing up in this range. Right? This is the most simplistic form of a bearish fake out. Like whenever you have a bearish fake out, there's a very high probability price may push in the opposite direction. And as we continue up towards the resistance area, there's another very high probability that with volume, we can continue breaking up. And this is where the trend can continue to push up. Now, another scenario in this, which happens a lot of times, is basically, let's say that we have a candle that closes within the range, right? It closes somewhere in the middle of a range. Now, whenever a candle is closing in the middle of a range, this is not the right time to probably take a trade at this point because we're closing in the middle of a range. What are you going to do in the middle of a range, right? You have to identify what probability there is for price to move up and what probability there is for price to move down. There's a 50-50 probability that price will either move up or it's going to move down. And as we've discussed in the previous lessons, that whenever you're trying to take a trade, make sure your entries are taken near to the zones, right? So in this case, there's probably, if we're following perfect price action, perfect market structure, there has to be some sort of a bearish move down. We create some sort of a support. And if there's volume, we may continue to push up. right? But this is not the ideal state to take a buy in a bearish fake out, because essentially what's happening is now your probability of price moving up comes down from 70% or 80% to maybe 60%. Right? Because if this is a 30-minute time frame, we've created a resistance at this point, right? So this is where complications happen. So whenever you're seeing a setup form, let's say a fake out setup, for me personally, I want to see something perfect formed, right? And these things also do happen. Something perfect is going to be something like this. That's it. That's all what I want to see. Because if I'm trying to take a trade at this point, on the next candle right here, my stops are below the 30-minute candle, and then I'm not expecting this new candle to break the low of the previous candle. I'm just expecting it to continue to push up. That's all what I'm expecting it to, right? Now, when it comes towards managing risk, we have to go over the risk management section. We manage risk on the 15-minute time frame, when we're taking on 30-minute candle trade, and so on and so forth, right? So fake outs, they do happen. We have to see if the candle confirmations are there. And we've talked about this a lot of times too. Make sure that the trade you're executing on or the candle setup you're executing on is exactly how you picture in your mind. Because most of the times, those are the cases that do work out. All right, as simple as this sounds, it's actually that simple. The only problem is we have to just wait. We have to wait for candles to print something that we can recognize. When we can recognize the pattern, when we can recognize a certain pattern or a certain way the candle is closing for us to actually execute on a trade, then executing on that trade becomes much more easier, because we know in our mind that we've seen certain things happen over and over and over again, and also there's a higher probability for certain things to play out. But at the same time, we have to understand probabilities as well, right? Now these setups, like these setups we talked about, there's a higher probability for them to play out. There's also a lower probability they may not play out. So that's where your psychology comes into play, and we've discussed this all over again as well, that whenever you have that lower probability playing out, you have to manage risk. That's a part of trading. That's a part of your trading plan. That's a part of your risk management strategy. So whenever you're fronted with a situation where that small probability of a trade not playing out, that's when you got to mitigate risk, right? But in the higher probability, like 70% chance, 80% chance, things are playing out, and you do see fake outs happen, that's when you're going to say, okay, you know what? We're going to continue with this and we're going to execute on this. Again, fake outs, they're complicated, right? They're complicated. You can't anticipate a fake out until and unless a candle really closes in that direction, right? So in the start, what I'm going to say is just like sit back and watch on the charts how fake outs have played out. If you were able to recognize them, if you were able to anticipate them as candles close back in the range, right? Go over the previous charts, go over the 30-minute charts, 1-hour charts, and look at times of volume. Look at times when price was ranging, and during the time when price was ranging, look to see whether there was a fake out. If there was a fake out, look at the candles and really ask yourself that where could you have executed a profitable trade. Now, you're not going to get better in a week or in a month. This would take like 3-4 months of deliberate effort and deliberate practice in seeing the same things happen over and over again. Awesome. That's all for fake outs. We're going to see you in the next section.